Should I borrow money from banks or non-bank lenders? It's one of our most often asked questions. Making an application for a property development financing is not as scary as it seems. Getting a bank loan for property development isn't always the best solution. As financial advisors, we assist our clients pick the best alternative for their situation and goals. As a minimum development return, the bank's project margin requirement must be 20%. As a developer, it's vital to think about project margin before starting a project to see if it's worth producing right now. Project margin will be considered by the non-bank lender as well, although there is no minimum project margin requirement. Banks demand developers to invest at least 25% of the entire cost of the project in order to complete it, as well as ensuring that developers contribute to the cost contribution. This is not a requirement for most non-bank lenders. They are more concerned with the loan-to-value ratio, LVR, based on the project's overall worth, which is the selling price. LVR registration for both bank and non-bank lenders is set at 60% of the loan-to-value ratio. Non-bank lenders used to be more willing to lend, but because of the present turbulent real estate market and COVID concerns, they prefer to maintain the LVR within 60% of the purchase price. If a development project's total cost surpasses $1.2 million, banks expect QS to be involved throughout the course of the project. In most cases, QS would add at least $50,000 to $70,000 to the final cost. Non-banks, for the most part, do not require QS involvement, and lending rules are typically straightforward. The fundamental advantage of banks is their cheap financing costs, particularly in terms of interest rates. Simultaneously, the demand for utilizing some professional services, such as QS, would raise a significant portion of the project cost, easily offsetting the bank's gain from giving a cheap interest rate. Because customers assume risks when acquiring an off-plan house, presale will force developers to provide lower prices in order to attract potential purchasers. Presale will diminish the developer's project return if the property value looks to rise in the current housing market. Developers will also pay extra because of the set pricing. In general, many developers prefer non-banks for small and medium-sized development projects costing less than $4-5 million. Banks are better appropriate for large-scale real estate development projects costing over $4 to $5 million. For this reason, large-scale developers prefer pre-sales with fixed prices and expert help from QS to minimize risks. The cost of non-bank lenders funding development projects beyond $5 million is too costly, especially in comparison to banks, and certain other advantages are lost. However, non-bank lenders are unable to fund beyond $5 million.